Good evening or good morning, everybody. Whenever you are listening to this, we are coming at you on Wednesday evening. Our guest today is Edward Woodford of SeedCX, which is a platform that allows for institutions to trade digital assets. I think this is going to be a really interesting conversation. Institutional money is a big talking point within the community. The question is always, when is institutional money coming? Has it already come? Basically, when are they going to pump everything up and make everybody fat, rich, and happy? So, Edward, welcome in. Excited to talk to you.
Yeah, no, thanks for having me. Good to talk.
Absolutely. So first of all, just explain for anybody who doesn't know a little bit about SeedCX, perhaps the history of the company, how it came to be, and what you guys are aiming to do.
Yeah, absolutely. So I co-founded the company close to 4 years ago now. And the foundation of the company was looking for novel asset classes where, for whatever reason, conventional financial institutions had not stepped into, whether that be because of some regulatory uncertainty, but very often it was, in our view, because of some visceral reaction that this thing wasn't something to be touched. And so we looked at a number of products. We started off launching things like avocados and limes, as well as industrial hemp. And we moved full time or solely focused on cryptocurrencies about 2 years ago. And the reason being was that we felt that we could get some competitive edge in the space, whereby traditional finance, for whatever reason, had not fully embraced this asset class, and despite the fact that it was growing very, very quickly. So what we do is two main things. We are an exchange. We allow groups to buy and sell in a regulated, secure fashion. And we today have our spot market that is live, and we're doing several $1 million a day. And we're also launching a derivatives platform. So we are fully registered as a derivatives trading platform. The technical term is a swap execution facility, and that is regulated by the Commodities Futures Trading Commission, or the CFTC. And we're approved, and we're at the very final steps of getting our contracts through regulatory approval. And so we'll be launching those later this quarter, subject to regulatory approval. So that's the exchange side. The second part of our business, which services our own market, is what we call our settlement infrastructure. And so essentially, we will actually move cryptocurrencies or move fiat when we receive a two-sided trade. And so what we do there is we settle for our own exchanges, for our own clients. But what we also do is there's been a big growth in, for example, the OTC space. We can receive any two-sided trade from clients, and we will move the assets for them, or what is considered money transmission here in the United States. So the regulated function of a trade. So in short, we do two things. We're an infrastructure player overall, but we do both the exchange side and then also the settlement side of the business.
Cool. Interesting to hear that you guys did not start out in digital assets. Was that something that you kind of noticed really quickly was going to be an area of focus for you guys, or did it kind of come out of the blue, or was somebody kind of trading on their own and they were like, hey, like maybe we should look into this, or how did that develop?
Yeah, I mean, we were looking at different asset classes, and it was early 2017, and we were interested in it. I'd actually worked for a cryptocurrency ATM whilst I was at grad school a couple of years ago. And so I had exposure to Bitcoin, wasn't particularly good with my timing personally, but I had always followed it and felt that there was some parallels, right? I mean, I think the narrative has changed so quickly that people sometimes forget what cryptocurrencies, what that term meant. And still means to some degree in kind of the ecosystem, but cryptocurrency was somewhat of a toxic term. And so we felt that there was a unique opportunity for us to come in and to take advantage of that, given our experience working with regulators on novel asset classes, but also the fact that we were very strongly banked. And so today we have the ability to offer 20 different types of fiat currencies on our platform, which is completely unique. And so we felt that we had some of the key pillars to enter this new emerging asset class where there weren't all of the features that are traditionally associated with a financial asset class.
Would you say like part of your job is to educate because it's such a nascent technology that you mentioned there's kind of this apprehension when some institutions first hear about it or some of the people you speak with. Is part of your job to kind of show them like, hey, this is legitimate, this is here to stay? Or are they kind of getting that on their own at this point?
Yeah, I think the narrative has changed from, I think maybe a year to 2 years ago, the overarching narrative that you would get from skeptics was this is something that's just used by drug dealers and people who want to break the law. I think the narrative and kind of the skeptical narrative, or where you need to focus on education right now, is explaining how it actually works. So the big concern when people, particular regulators or banks or groups, it's typically around security. So it's moved from an overarching negativity around the asset class and needing to educate that, look, cryptocurrencies is so much broader. Tokenization can potentially mean everything and anything. To this is how it works. This is how you mitigate risk. So yeah, I do think a big part of it is education, especially with some more of the traditional stakeholders that you do still need to engage with. To make it operate, especially in an environment like the United States.
Yeah, where regulations are aplenty, we should say. I mean, fairly business friendly, but in this specific area, constantly evolving, and that's got to be a tricky landscape for you guys to navigate, I would imagine.
Yeah, but it's also the opportunity, right? And it's about finding the right balance and act. And I think our view is pretty simple. We as a company are pretty averse to cryptocurrency specific regulation. The reason being is that I think it's a very narrow definition of this overall asset class. Our view is that blockchain and the subset of that is cryptocurrencies. We prefer to use the term digital assets. Potentially can mean anything. So it can potentially mean security tokens, or it can potentially mean commodities such as traditional gold being tokenized. And so by creating this very specific regulatory framework just for cryptocurrencies, I think that you're going to cause more harm than good. And what's better is to try and fit within the existing framework, acknowledging that this is new technology doing new things, but where there is a lot of case law and there's a lot of years of building up this regulation around that. So you have to try and fit within those kind of buckets. And yes, it's not a perfect kind of fit, but I don't think it's as extreme as a square peg in a circular hole. It's definitely a little bit rough, and you have to kind of wheedle it in, and kind of obviously there's these kind of gray zones about, can something be a security and then can it be a commodity one day? What exactly is a security in this space? But those are challenges that we've definitely faced before in other asset classes. So yeah, I mean, I think it is a highly regulated space. There's a lot of patchwork of regulation, but that's also because cryptocurrencies are so exciting, or digital assets are so exciting, in the sense that it touches so many different parts of the financial framework. It touches securities and commodities, and thus it makes sense that it touches a lot of different regulators.
Yeah, and it almost seems like like a little bit of a race among them to kind of be like, well, the SEC says this, and the Commodities Trading Division says this, and it's almost like a competition for who can like get it under their regulations. That's been my sort of perspective looking in, and maybe that's completely off, but
Yeah,
um,
I think the reality is that because of the fact that digital assets, because of the value of them is so powerful, or the use case that potentially will evolve is so powerful. It does touch all these different pieces, and so I think certainly there is a little bit of groups trying to claim jurisdictional, carving out jurisdictional pieces. But I think the reality is that all groups accept that this is going to touch every single regulatory body in the United States. I mean, every single regulator pretty much in the United States. We're talking about the Fed at this point. We're talking about FinCEN. We're talking about different state licensing agencies. We're talking about the SEC, the CFTC, the NFA. Simply like this acronym soup. Every single regulator is touching it because this technology is so broad ranging. And I think there is an argument that there is some jurisdictional kind of maneuvering. But I think in general, it's just because this asset class is so broad ranging.
What are the biggest challenges that you guys face? I mean, from the outside looking in, I would think just securing and like custodian services and just kind of managing of all the assets would be one of the trickiest things, but I'd like to hear your perspective on that.
Yeah, so where we think we're pretty unique on kind of the custody piece is what we call a blended solution between a completely decentralized system and a completely centralized system. And so the way that our trading system works is that during a trading session, trading occurs off chain. And then at the end of the trading session, the net positions are actually put on chain. So what will happen is that our internal ledger will always reconcile with the blockchain. And we think that this is a good approach, given the fact that this allows for each of our clients to actually have their own dedicated wallet, so they can actually go on the blockchain and actually prove ownership, which is important to certain institutions. And also, there's obviously leveraging some of the power of the blockchain, which is this decentralization. So, creating obviously this approach, which is which is innovative, it is challenging. But I think the biggest challenge is obviously the challenges that a lot of startups face, which is obviously attracting and maintaining the best talent. But I think specific to the cryptocurrency space is this is a space where trying to do things the right way, it slows you down a little bit. But I think in the long term that will be good for us. And put us in a very strong position. But it is sometimes, just speaking completely candidly, it is frustrating when you see people doing things which are clearly against the law, which we're not engaged in, and making significant amount of money from. But I think that's going to change, and I think there is going to be some enforcement actions which will set a level playing field. I think people talk about regulation, talking about changing it, which I think certainly needs to happen in certain places. But what is critical, what harms people the most, is when regulation is not applied equally across groups.
Yeah, I think one of the main things is I touched on this a little bit earlier, is that the broader community trading these assets, it's always when is institutional money coming, and I think that's with the goal in mind of bringing liquidity, exposure, and ultimately higher prices. To be honest, so what is would you say like an average client for you guys? What does it look like? What type of company? Perhaps what is their perspective on why they're getting involved in this?
Yeah, so it's a very broad client base. When we talk about institutional, often people have a concept of what they think institution means. When we use the term institutional, it means anything from a couple of traders with a couple of $1 million all the way up to a $15 billion hedge fund and everything in between. So we have those types of customers. I think when we talk about institutionalization, people often point to, for example, groups like BlackRock not being in the space. But I think that's misinterpreting or kind of misunderstanding how institutional adoption occurs. And I think what we're seeing here is a natural adoption cycle, just in a very compressed and very quick fashion. It makes sense for proprietary trading firms, proprietary meaning it's their own money, for them to enter the space first. The reason being that it's their own money, so they're not looking after people's assets.
Makes sense. Yeah, for sure.
And so obviously over time, then as you move down the pipeline, you've got family offices enter the space again because they have more flexibility over the assets. Then certain hedge funds enter the space because they can put particular carve outs. And then over time, you'll start to get asset managers in who have what people call a greater fiduciary responsibility, i.e. that it's not their own money. So you have greater flexibility when it's your own money. But when it's somebody else's money, you've got to be a little bit more reticent to get involved. But I think the pace of the evolution, I mean, it's incredible to think at this point, pretty much every single prop shop in the US and more broadly has some exposure to cryptocurrencies. Every single prop shop is at least looking at it in a very serious way. And the largest prop shops, the most well-known, all have trading desks at this point. And and over time, you're going to start to have that same cycle where everybody's talking about it. Some people will step in, and then it becomes normalized. And then you'll start to see the asset managers come into the space, especially with the likes of Fidelity stepping in, will create greater security around being able to to enter the space. And sometimes it's not all logical, right? Groups can entirely consistently say, hey, I need this group, I need this custodian to enter the space. It doesn't necessarily mean that they think that that custodian will have the best technology. It just simply means that if something goes wrong, they're not going to be embarrassed because this custodian has the balance sheet to back it up. Everyone trusts this brand. So I think we're just following the normal adoption cycle that we've seen, and pointing to just the fact that one entity isn't yet in the space doesn't mean that institutional adoption hasn't occurred.
Yeah, and I'm sure as you onboard more, it gets easier to onboard more because you can look back and say, "Hey, we've got them on board. Clearly, they think it's a good idea." So you guys should kind of hop on board, and you kind of there's this FOMO that kicks in, where nobody wants to be left off the boat and just kind of see everything, explode and volume pick up and numbers pick up and all that, and they're just sitting on the sidelines going, "Oh, I wish we had done that."
Yeah, I mean, the reality is that managing money is a very competitive space, and if you don't have some exposure to an asset class that increases the returns of your portfolio and increases your returns whilst reducing risk potentially on an overall portfolio basis, you simply won't be competitive. So I agree. I mean, as more groups enter the space, then it becomes harder and harder not to at least seriously look at the space. And it doesn't mean that these groups are going to have 50% crypto holdings, but they may have some percentage in digital assets. And I think there's a lot of research that's being done that if you have some percentage of digital assets in your portfolio, overall, your portfolio has better returns, not only better returns, but better returns on a risk-adjusted perspective.
Yeah, absolutely. I remember reading a study, I think it was only a couple of weeks ago, about how a portfolio would be altered, like a traditional 60/40 stock bond portfolio would be altered by doing just 1% into Bitcoin over the years, and how that would affect the Sharpe ratio, the risk-adjusted returns, all that stuff, the net, the alpha, all that good stuff.
Yep,
Um, and
absolutely.
yeah, and I think that people on the outside, like, they kind of think like it's like you got to go all in or nothing. But we're
Yep.
talking about entities with such massive sums of money that, like, let's take like the Yale endowment, for example. I mean, if they allocate 1%, that is a gigantic amount of capital, billions of dollars.
Yep.
And it's going to be interesting to see. I don't know if we're quite on the level where they're doing that sort of thing yet. Maybe you can chime in on that. But when that does happen, I mean, this is still a pretty small space overall. So that's going to have a big effect, I would think.
Yeah, and some of these groups simply could not enter the space, even as recently as a year ago. If you wanted to your point, some of these managers manage so much money that even if they want to deploy a small, very tiny percentage of it, there simply was not the liquidity to be able to do that and to be able to exit those positions. And as liquidity has kind of increased in the space, then it allows these groups, very large groups, to start to look at this space more seriously. Groups won't enter the space if they can only deploy a fractional amount of what they actually want to potentially invest in the space. And it's interesting that you mentioned the Sharpe ratio, actually, which is, as you said, the risk-adjusted returns of an investment. I think when we talk about Sharpe ratio with clients, a lot of the time people just look at the price, but I think this is one of the few asset classes historically where there has been a high operational risk. And so the traditional Sharpe ratio doesn't necessarily make sense. You have to include operational risk in that Sharpe ratio to really take a good look at that. And that's our goal, is to essentially reduce operational risk to as close to zero as possible, so that it's not considered in an assessment of whether to enter the asset class. And it purely is, as you said, a risk-adjusted view on whether to have crypto assets in your portfolio to some degree.
What has the kind of energy been like in the office? Let's say I'm looking at a chart here. Let's say the past several months, we'll say, when the market's kind of turned around. I would imagine that's affected the mood of everybody.
Yeah, I mean, I heard someone the other day was speaking to a pretty bearish person, and they made the joke. When the price of crypto was falling, everyone in crypto told me that the price didn't matter. But as soon as the price rebounded, everyone was talking about the price.
Yeah.
And it is a reality of the space that there is a strong sentiment right now in digital assets. Look, I mean, obviously right now volumes are up, volatility is up, which encourages more systematic trading. and that rises all ships. Just from a purely price perspective, we're the only exchange that I know of that actually doesn't allow employees to actively trade cryptocurrencies, and we do that for a reason, which is to essentially make sure that as an exchange we are completely impartial with the assets that we list and with the way that we treat clients. But yeah, I mean, volumes are up. There is a high degree of positivity. It definitely engages people in the space that previously weren't, to your point of FOMO. And so overall, I think it's, there's obviously been a big uptick, and positivity is definitely on the up.
What was it like approaching some of these institutions and potential clients that you're pitching to in 2018? Because that was maybe not the very beginning of when you guys started to look into this stuff. I think that was 17, if I heard you correctly earlier.
Yeah.
But what was that like when the markets are not doing well? How do those conversations go?
Yeah, I mean, I think a lot of these groups, I think the crypto winter, as it's been termed now, it changed the conversation from just being about price, which I think was actually really, really important for broader adoption outside of obviously crypto-focused groups, because it changed the conversation from, okay, what is the price of Bitcoin, to, hey, this is potentially so much bigger than just Bitcoin. This is so much bigger than just the price. So for us, it was pretty positive with institutions. I think a lot of what was built and what we're seeing now was built during the crypto winter. So it definitely didn't slow the kind of aggressive nature of some institutions entering the space or building out desks. But yeah, clearly price is something that creates FOMO, and it creates a degree of positivity. But it can't only just be about that. This space needs to survive another crypto winter, and hopefully it's not as cold as the last one. But for the space to truly grow and to be truly transformative, from say what it is today, where roughly $200 billion is traded daily, I would say, to something that is traded, and that's tiny compared to other asset classes. For this to be truly transformative, it needs to become a lot broader than just price. It needs to be about usage, adoption, these kinds of questions that started to be discussed a little bit more, because you know what, price wasn't as sexy anymore. So it forced people to actually ask other questions and look at other metrics, which I think was important.
So what do you guys look at when you're looking to maybe add new assets? Is it something where everyone else is kind of agnostic to what it is, just matters that it's volatile and you can trade it? Or what do you guys look for in terms of increasing? You already offer a good amount, but like adding new things.
Yeah, so from a strategic perspective, where we're focused this year is increasing the number of fiat underlying pairs. So right now we offer USD underlying, and in the next 3 months, we're going to expand out to offer euro pairs as well as Japanese yen pairs. And so we are essentially going to treble the number of products that we offer overnight, by offering obviously broader fiat pairs, which will then create interest in trading opportunities across those different fiat pairs, which we think will be really interesting. In terms of what assets we list, right now, the biggest test is whether it's a security or not. We have a pending broker dealer and ATS with FINRA and the SEC, but ultimately, what needs to be listed, or what we can list today, is what people typically term as utility or commodity tokens, i.e., non-securities. And so the biggest gating factor is a confidence about whether something is a security or not.
Gotcha. Makes sense. So we saw things like a little bit ago, how they termed Ethereum not a security, which I think it happened during one of the darkest periods, but it's certainly extremely bullish, I would imagine, for you guys.
Yeah, I mean, I think this goes back to my point about not having a horse in the race. Our horse is the overall asset class. As an exchange, we are bullish on the overall asset class, but not on individual assets. And I think that's really important. The fact that some exchanges take huge positions in certain tokens and then list them, prioritize them, etc., does innately create a conflict of interest, which is not very rarely actually disclosed. And so our goal is, look, we're not here to pick winners. I'm not here to say one token is better than the other. That is ultimately down to the market to decide. My role is simply to be an infrastructure provider and to make sure it's a fair and balanced playing field, and to make sure that everyone is compliant, so that they don't end up with something that ultimately they cannot hold, or will get in serious trouble for actually holding.
Yeah, we're seeing some of that stuff. You look at some of the US exchanges and the mass delistings where, if you had one spot to trade it and you're holding that thing, you're out of luck for the foreseeable future until somebody else kind of takes that up and gives you a form of liquidity.
If, if ever.
Yeah.
So it's a great point. That, I mean, we see dozens of delistings in the past, in the past few months, from some of the from some of the large exchanges. And you're absolutely right. Ultimately, who it hurts is the customer. Those delistings occurred very, very quickly, and then what are you meant to do? Try and join an offshore exchange where technically you're not meant to join that. How do you get out of those assets? It's a great point.
I like the horse racing analogy. I remember a quote from Arthur Hayes, CEO of BitMEX, where he's like, I don't need to own a horse. I own the track. And thought that was very interesting. And it's just kind of it's a bet on like a broader, like succeeding of the industry, not anything in particular in it. Because we see thousands of different, assets, most of which I think people would agree are probably not going to be worth very much long term. But as long as those keep coming to market, then there's a market for them.
Yep. Yeah, exactly. I mean, most new businesses fail. So it's and a lot of commodities come and go. We've seen it, for example, even the traditional markets. Even the famous pork bellies is no longer traded. Certain assets, certain stocks that were very, very large are no longer traded. So this concept of everything needing to win, I think is a misnomer. You're absolutely right. As an exchange, you're taking a very diversified bet on the overall asset class, and we are bullish on the overall pieces, but no one really knows exactly which part of the industry is really going to take off, or which tokens will really be here in 10 years time and have that longevity.
Do you have any personal thoughts on how you see the industry evolving? Is it going to be securitized tokens, or is it going to be maybe utility tokens, or like how that kind of is going to morph going forward, in your opinion, and how that ties in with perhaps the institutions and what they'd like to see done?
Yeah, I think the thesis around tokenization improving all asset classes needs to evolve, right? Well, which asset classes most benefit from tokenization? And very often people say, we're going to tokenize this and thus it will trade successfully. If you look at most new contracts or most new things that are launched on traditional markets, such as the Chicago Mercantile Exchange, most of those contracts fail. There's a very, very strong bias towards a few number of actual contracts. So I think the thesis around tokenization equals success of trading is not correct. Where we see particular growth and where we're bullish on in the very short term is broader tokenization of precious metals. I think you're going to see a lot of groups starting to list those forms of assets, which will be interesting because obviously cryptocurrencies are often termed stores of value and kind of competing head to head with the gold. But we're bullish on overall tokenization, and that's why we built our settlement infrastructure to be decentralized in the sense of each client having their own wallet, because ultimately we see Bitcoin as the wedge to broader assets being tokenized. And ultimately, if you're bullish on tokenization, you need to build a somewhat decentralized system. So I think over the next kind of short term, you're going to see tokenized assets. I think we're going to get greater clarity from regulators around securities. And often people think securities just equates to equity, shares of a company. But really, securities means a lot of different things. It means bonds. It means treasuries. So it's a very broad term that potentially be very disruptive. But look, you've got a huge amount of big players starting to enter the space. I mean, the fact that Facebook has entered the space definitely changes things, I think, in many people's minds. And exactly how that use case develops I think it's early to tell. So in summary, it's kind of short term. I think we're going to see precious metals, and then with greater regulatory clarity, we're going to see greater innovation within the broader sense of securities.
Very cool. Well, Edward, that flew by. That about wraps up the time we have allotted for tonight. I want to thank you for coming on. Is there anything you want to leave with the listeners, maybe where they can find out some more information about you?
Yeah, absolutely. It's simply our email, or sorry, rather, our website is SeedCX. So that's SEED, C for cat, X for X-ray.com. And looking forward to hearing from some people.
Absolutely. Appreciate you coming on, man.
Yeah, appreciate it.
All right. Take care, everybody. We will talk to you next week.